Boop, boop.
Hello, hello, hello.
We're here.
We made it.
We made it.
Let's do this.
Yeah, we had a big day yesterday. We
had a big weekend, but yesterday was really good.
Yes, we may or may not have taken it a bit easy this morning. So
I mean, I did a coaching call already.
Yeah, that's true. You did a coaching call. Okay, maybe I took it a bit easy this morning. We were a bit slow to start the day.
That's true.
We'll say
yeah.
that.
Kind of slept in a little bit.
Yesterday, we were out in Pembroke doing the inspection for the 24 unit that we are likely going to be closing in the, next couple
TBD?
months. We'll see.
TBD.
But it was
It could be anywhere between 2 weeks and 24 weeks.
Yes.
So...
But soon, it was our last, other than financing, it was our last, checkbox, really, on the deal. Yep. So it was also our first time out there with our partner, Alfonso. So it was Alfonso's first time seeing the building. He loved it. He kept saying what a great asset it is. So that was really exciting. We talked about the two buildings. We talked about the lot and the build and what that's going to look like. So it was nice to have him out there. Obviously, it was nice having the inspector out there as well. We followed him, learned a ton during that inspection.
I was like this with the inspector. Yeah. show me everything.
The only place you didn't go was into the attic.
That's true.
But
he went up there all by himself.
Yeah, it was just itchy to watch. So we were like, see, look, I'm itching just talking about it. But yeah, it went really well. It was a long day inspecting two 12 units. So inspecting both buildings was a lot. That means 2 attics, 2 exteriors, a lot more maintenance rooms to be looking at. So it was a long day, but it was a good day. And yeah, everything's looking good from that perspective.
Yeah.
So we aren't talking about inspections today. Maybe at some point we'll do one on inspections. We'll see. Instead, today we wanted to talk about debt, because this is a big discussion that I have with a lot of my students when they're first starting.
Yeah, I think it's really a mindset thing that it boils down to.
Yeah, that's a tricky thing, because I think for a long time, debt was such a don't go there thing. There was a generation where people just didn't want to deal with debt. They didn't want to have debt. They didn't want to carry any debt. Mm-hmm. Everyone was afraid of debt. And that's changed, but a lot of the people that kind of grew up with parents that came from that generation still have that mindset.
Yeah.
So I want to talk about debt today. What is debt? What are the benefits of debt?
Good debt versus bad debt.
Good debt versus bad debt. And, is there a difference? Is there a good debt versus a bad debt? And I think in our opinion there is, but yeah, we'll get into that.
For those of you that have never tuned into one of our power lunches, welcome.
Yes.
We try to do these, we do them every Tuesday. We've been pretty consistent for the last few weeks, so it's
Pat
good.
On the back. Pat on the back.
Yeah, thank you.
They're always here, so they're always on my profile.
We're also uploading them to YouTube.
Yeah, so if you ever miss one.
So go subscribe to our YouTube channel.
Yes, if you miss one, they will be on YouTube, but we will... As consistent as we can be, we will be here on my account live at 12:30 talking about a new topic. We do encourage you to participate. So if you have questions, ask your questions. If you're just hopping on, introduce yourself, say hey. We like to know that you're here.
Yeah, we want these to be as interactive as possible. So drop your comments, share this with anybody that you think might benefit from it. Mm-hmm. Share it with your community, and drop a like. Yeah. And if there's ever a topic that you are interested in and you want us to talk about, as long as it's kind of within our wheelhouse, we might not, take on a topic about where's the best place to Airbnb in the States or something like that, because I would have no idea what to... I'm just trying to think of what I don't do. I don't really do Airbnb, and I don't do stuff in the States. So it's like, what wouldn't I know? We have some experience with Airbnb, actually. We've been through the process in Ottawa, which is a lot more than what a lot of people have to go through.
That's fair.
Getting a license and everything. But
if there's a topic that is within our wheelhouse, we're happy to talk about it. So bring them to us, and maybe you'll see it as a live.
And if it's not within our wheelhouse, we're actually considering bringing people onto these sessions. So maybe if it's something like, I don't know, corporate structure, then we can bring a lawyer on or something like that to talk about their experience with it and be able to share that. So more, maybe if it's outside of what we can do, we can bring somebody in to chat.
Either way.
Yeah.
Chat
I think that would be a lot of fun. Let us know if you guys think that would be a good idea.
Yeah. So let's get on to today's topic, because we do like to talk and I don't want this to last forever. Yeah. So debt.
What is it?
What is debt, to start with? I think we all have a pretty good idea of what debt is. So what's your definition of debt? What is it?
Borrowing money.
Yeah.
I think is the simplest way to put it. You're just borrowing money.
Yeah.
Usually there's an interest rate tied to it. Sometimes it's 0%.
Yeah. And what do you think makes people so nervous about debt? Because I do find that talking to a lot of new investors and a lot of my students, they're very nervous when I start talking about debt and the risk.
How deep should I go with that answer?
We'll do surface level for now. We're just getting started.
Surface level, what makes people nervous is they don't want to owe money on anything. They don't want to have that kind of, I don't know, cloud over their head or weight on their shoulders of owing anything to anybody.
Yeah, that's true. And I think for a long time, especially with obviously my mind goes to real estate because that's what we're doing. But I think for a long time, real estate was more affordable and people could buy real estate with little to no debt. And we're talking 30, 40 years ago, which is where we get into the generation of people not wanting to hold a lot of debt.
Yeah.
Whereas now it's, I'd say, close to not impossible, but it's not something that's attainable for the average person. Yeah,
debt would be lower amount of debt, but I mean, a higher interest rate. I mean, interest rates were at like 18%. So if we think that we have high interest rates right now, just look at historic levels.
Yeah. And I guess at that point it was expensive, right? Like if the debt was so expensive, you wouldn't want to necessarily take on too much of it.
Yeah.
So this is a big discussion that I know I have, and I think you have with a lot of your students when they're starting out in real estate, because debt is such a big part of real estate. It's like this incredible resource that we have to be able to invest in real estate. And there's a mindset shift that needs to happen for a lot of people when they're starting out, because debt is really what's going to allow you to expand and grow within the real estate realm. So why don't we talk a little bit about what that looks like for you and like for your students when you're talking to them about debt, like kind of that first conversation.
I think it all boils down to mindset, right? You really need to understand the difference. And this is where we can really start talking about the difference between good debt and bad debt, right? So bad debt would be something that is buying a liability. Credit card debt, if you're trying to buy shoes or a car, unless, stay out of the comments, if you plan on buying a car as an investment because you're renting it out or something like that, that's different. But typically, something that's not going to go up in value or something that's not going to put money in your pocket. But if you're borrowing to leverage and receive income from that, and that income is higher than what the maybe the interest rate is or whatever you're paying on that debt to carry it, that's good debt.
So the basics are really bad debt is if you are using debt to buy something that's taking money out of your pocket.
Yeah.
And then if you're buying something with debt that is going to be good debt, that's something that's going to be putting money in your pocket that's going to be covering that debt so that you're not having to cover it out of your own pocket.
Yeah.
Typically.
Yeah, exactly.
And I know there's some like kind of gray areas in that. Some people will say, well, you know, I know people will use their HELOC and sometimes have to cover a part of that HELOC when they're investing for, like, say, equity in a property. They might have to use their HELOC to buy into that property. So they might have to cover a piece of it until they get that HELOC back. So that's kind of a gray area where they're like paying out of pocket.
You're getting into creative strategies.
Yeah. Like you're covering the debt out of pocket, but you're also gaining ownership in a property, and you're going to have that paid back eventually, where your returns are basically going to be infinite in some cases. So there are some gray areas, but I think that's kind of the basic differentiator. Is your good debt is going to be helping you buy something called an asset, and then that's going to be putting money in your pocket. Yeah. Whereas bad debt is being put towards something that's not going to put money in your pocket.
Depreciating.
Depreciating. So what are some examples that you use when you're talking about bad debt with your new students?
Typical credit card debt, I think, would be the biggest one, right? True. So everybody's buying everything on credit, and the money is not coming out of your account until you pay off your credit card. And a lot of people are carrying a balance on their credit card. So that's ultimately, you're not leveraging a credit card to its fullest potential. In my opinion, a credit card is, number one, it can help you build credit, but you're going to get points on a lot of the credit cards that are out there. And for me, buying stuff on credit cards and then paying off that credit card before there's any interest on it, to me, I'm leveraging the ability of that credit card. But ultimately, whatever I'm buying on that credit card is going out of my bank account eventually when I pay it off, right?
Yeah.
So I'm not using it to give myself any income.
Yeah, I always think of like your typical consumer, like someone who's going to go to the mall, basically, with that credit card.
Buying shoes, buying stuff.
Yeah.
Why don't we just say stuff?
Yeah.
Buying stuff.
So things like, like you said, shoes, cars. We can get into the idea of your single family home. Maybe we'll save that for a little bit, but we'll save that. So things like you're going to the mall, you're buying yourself shoes, you're buying yourself clothes, you're buying yourself things that aren't going to get you a return. Obviously, some of these things you need, right? Like technically, to be in society, you need to wear clothes.
Yeah.
But
consumers really drive the economy.
Yeah.
Right?
Yeah. But it's really you using your debt and having to pay off that debt now because you've purchased maybe a Louis Vuitton bag that you couldn't really afford, and now you have to pay debt on that.
Yeah.
So that in my opinion, that's bad debt.
Yeah.
Especially something that you can't really afford it, but you're using credit in order to buy it.
And it's not a write-off.
Yes.
If it's something that's not a write-off.
Vacations, right? Like I think if you're using debt to
of course,
buy yourself a vacation.
Weddings. People are paying up. No, but people are paying off their weddings for months, if not years.
Yeah.
Right?
Yes,
they go into debt to get married.
They are. Man, who knew that marriage could be such a liability? But it's true. Like it's really anything that you're using your credit for that you can't really afford that's not going to be paying you money back.
Yeah.
So I think we're all pretty clear on what bad debt is. So why don't we dive a little bit more into good debt? Because I think this is where people get a little bit nervous because that word debt is still in there. But now you're putting the word good in front of it. And suddenly this whole mindset about debt being bad and don't owe anybody anything and don't use debt to buy anything, pay everything cash. Suddenly you're turning that and putting the word good in front of it. You know, like what is that good debt? What does that look like?
Should we we'll call it leverage?
Yeah, we can call it leverage.
Instead of calling it good debt, we can call it leverage.
Okay.
And that gets rid of the word debt. And now it's more of a strategy, right?
Yes.
People use debt in order to increase their buying power, essentially, and purchase something that they wouldn't have otherwise been able to.
Yeah.
And also, we all have heard the term OPM before, other people's money, right? So debt is essentially using other people's money.
Yeah.
You're now borrowing money from somebody else. Could be a bank, could be a private lender.
Yeah.
To buy something that you wouldn't have had the capital to be able to purchase on your own.
Yeah. And the important part is that you're buying something that's going to be paying you money and putting money into your pocket and going to be going up in value, something that's an asset. So we talked about like assets versus liabilities. That really goes hand in hand, I think, with good debt and bad debt. So talking about the 24 unit, $6 million deal. I don't have $6 million in my pocket. I don't know about you.
No, but even to me, it doesn't make sense to bring on partners to pool $6 million together when we could go to the bank and leverage 80% of that.
Yeah.
Right?
Yeah.
And then only have to come up with 20% out of our partners.
Yeah, it's actually
ourselves.
It's right? Interesting because hi Peter.
Hey,
Good
Peter.
To see you. I had this conversation with a student yesterday because she presented a deal to me and was talking about bringing on a person that had deeper pockets, and they were going to be able to basically give her a loan instead of the bank giving her the loan. And she felt that was going to be a safer option because she wasn't lending money from the bank. She was lending money from a family member instead.
Borrowing. Yeah.
Or sorry, borrowing from the bank versus borrowing from the family member. And I was talking to her and I was like, you have such a massive opportunity here. Because now instead of using this, we'll call it $1 million, instead of using this $1 million to fund this one deal, why don't you go to the bank, get them to give you what is now $800,000, get them to give you some good debt, because this is debt that as long as the building is going to cover it, that's good debt. So you're going to go to the bank, get good debt, and now you're able to use this investor's funds, a portion of it in that deal, and you can maybe now use $200K there, $200K here, $200K here, and now you've expanded your portfolio much faster than if you had put that one person's money into that one deal.
Yeah.
And I think that's where leverage is so powerful in the real estate world. It really allows you to scale your portfolio so quickly.
Yeah. Because again, you don't have to come up with the entire amount of capital yourself. You can leverage the bank's money to buy an asset that's bigger than what you could potentially do on your own, or multiple assets because of the example you just gave.
Yeah. And I think that's where investors getting comfortable with debt is so important, because as long as you understand debt and as long as you understand the payments that you're making and understand that the asset should be covering those payments, debt can be really, really powerful. And debt is really how so many people scale so fast in business, and in our case, in the real estate world, is because they understand debt. So I think people that are scared of debt don't really understand it as well as...
Or understand the power of it.
Understand just it in general. So, and I think that's where that mindset shift happens, to be able to go from thinking that all debt is bad. Yes, mindset shit. To understanding that not all debt is bad. And if you have a good understanding and a good relationship with debt, I think that's important, is your good relationship with debt. Now you're able to use it to really scale what you're doing.
Yeah.
And I was talking to her about this yesterday. It was our first coaching call, and she was like, whoa, yeah, like that makes a lot of sense. And
it's just a different way of looking at it.
Yeah, ultimately. It's a different way of looking at it. And obviously debt can still be scary, because if you over leverage something, this is where things you get into trouble. But as long as you understand debt and you understand leverage and being able to use it properly, that it can be a relatively, it doesn't have to be a scary thing. It doesn't have to be unsafe if you use it properly, and now you're able to scale your portfolio a lot faster. So that actually brings up a really interesting question. And we were kind of talking about this earlier, is can good debt can it become bad debt?
Yeah, of course.
And what does that situation look like? When does good debt, or what you perceive to be good debt, now transition into bad debt?
When it's no longer putting money in your pocket, to put it most simply, without getting into different specific examples of where that could happen. In real estate, obviously, can happen in multiple ways, but ultimately, when you're now having to service that debt on your own.
Yeah.
So now you're paying out of pocket, and the asset is no longer putting money in your pocket. Now it's become bad debt.
Yeah. And especially, I know we talked earlier about maybe you have to service your HELOC if you're investing in it. So maybe if you're kind of expecting that to happen, and in the end it's going to be you
really want to look at the bigger picture.
Yeah.
You don't necessarily just want to look at the short term. If you're covering the debt for right now, but it's going to pay you later, then that can still be looked at as good debt.
Yeah.
So
and
that's
really
where
case by case, I think, in that situation.
Yeah. And that's where the single family home / personal residence discussion can get a little bit muddy.
Yeah.
Because people will say, well, yes, I'm paying for my house out of pocket now, and I'm paying for all the repairs and everything now, but it's going to go up in value.
Mm-hmm. Yeah, that gets a little
and that's it'll pay me back when I sell it or something like that, right? This is, I think, for a lot of people, their single family home is the biggest purchase they'll ever make. Mm-hmm. And probably, if that's the only real estate they're going to buy, probably the best forced savings account they will have. Mm-hmm. And I like to call personal residence a savings account.
Yeah. And like you said, if that's going to be their biggest real estate purchase, then it might not be a bad thing. But a lot of investors talk about how a single family home can actually be a liability and therefore basically bad debt in a single family home. So maybe we'll leave that one for the end. I think we'll go into a little bit of discussion about that.
What do you guys think? You guys in the comments, what do you guys think about debt, good debt versus bad debt? We'd love to hear your opinions as well.
Yeah, and good debt becoming bad debt in certain situations.
Have you seen good debt become bad debt?
Mm-hmm. So if you have any
hey, Christian,
any thoughts on that, feel free to pop into the chat. I know we've seen good debt become bad debt. We've seen leverage and what we wanted to be leveraged turn into bad debt.
Yep.
And I think a lot of people did when
we talked about that on our last
on the resilience one.
Yeah.
A lot of people saw that when the market shifted and the interest rates went up, right? Maybe that's part of where good debt becomes bad debt is if the interest rates go up. So if you're on a variable mortgage and you got a mortgage back when rates were at their lowest, back in early 2022, you were laughing at your 1 to 2%.
2021 at this point. So yeah, I think because 2022 is when everything started to go up, right?
Yeah, well, it was mid-year.
Either way, yeah. During COVID, when the rates were really
when
low.
They were low. So at that point, you're killing it, right? You're borrowing at such a low amount. You're maybe buying let's go back to investment property.
When money is free, everybody's a genius.
Yeah, when money is free, you're buying yourself this investment property and it's cash flowing well and you're happy, and that at that point is good debt because that's putting money in your pocket. But then suddenly interest rates go up, you're on a variable mortgage.
Go up and up and up and up.
And now this variable mortgage has gone up significantly, and suddenly what you're cash flowing doesn't cover that debt anymore. To me, that could be a transition from this being good debt to now this is bad debt, because now you are having to potentially pay out of pocket, not just with the cash flow you thought you were going to make, but then the cash flow plus whatever you're pulling out of your pocket to be able to service that debt.
Yeah.
And I think this is where being very conservative when you're running your numbers, we always like to, with our investment properties, go into fixed mortgages. We always say that we don't really care what the debt costs as long as it makes sense for the deal.
Yeah.
So people are like, well, what if interest rates go down and you can pay less for that debt? Well, I don't care as long as the building and what we're cash flowing makes sense with that debt.
Yeah.
Then I'd rather be safe and know what I have to pay for the next 5 to 10 years.
Yeah. Especially if it's just buy and hold, then it's easier to just know what your monthly payment is every month and not have any surprises. Yeah. Essentially. That's the power of fixed, especially in a rental property.
Yeah. And again, that's a preference for us. I don't think every investor does it that way, but that's just something that we prefer. We want to know, we want things to be as fixed as possible so that we know exactly what we're paying each month. And I think that provides a little bit of comfort, security, and knowing that that debt is going to remain good debt as much as possible.
Yeah. And when you're talking about risk level in an investment opportunity as well, knowing exactly what your monthly payment is going to be is safer than having that wild card of what if the rates do go up.
Yeah. And I think, again, this comes back to understanding debt and having an appreciation for it. Hey, Paul, it's good to see you.
Welcome.
If you have any opinions on debt, good debt, bad debt, we'd like to hear them. And I think this is where getting that education around debt and how to use it properly and how to be as conservative with it as possible is so important. because a lot of people can get themselves into trouble if they think they're getting into good debt. They, maybe don't get themselves into a fixed mortgage, or they over leverage.
Over leverage is a big one.
Could become a big problem.
We saw it a lot in the flipping space.
Yeah.
There's a lot of over leverage.
That's where a lot of people get into trouble. Having, there are strategies out there where you can buy a property with 100% leveraged money.
Or 150%.
Or even, you can go higher maybe especially if you're in the value add space. So either in the flipping or the burr space, people will lend potentially over 100% loan to cost. Maybe they'll go loan to value or loan to after repair value. And that's where things can get a little more risky. It can be great. Don't get me wrong. It's not like it's a bad thing to be over leveraged necessarily, but sometimes it can get you into trouble. So that's where the risk ends up going up.
That's the risk level. And the banks are smart, right? The banks will typically, your standard traditional lenders are going to lend up to 80%, right? Because they know that being over leveraged is risky. And obviously banks are not risk takers. So they will only lend up to 80%. You need to put some skin in the game.
Yeah.
And you need to ensure that the bank's investment is safe. So if the property value does go down, then the bank still isn't over leveraged.
Yeah, exactly. So again, the bank has a very good understanding of debt, and this is where they do these things to make sure that they're putting themselves into as safe a position as possible. Yeah,
Powell, exactly. So Powell said, I did a transition from variable option being the ideal product to more long-term locking in to a fixed rate. Yeah. It makes no difference. Exactly. If the deal works on day one with this rate, then that's good enough. I mean, people can be...
Don't get greedy.
Yeah, I was going to say the word greedy, but people will get greedy and say, oh, but my investment, like variable has always beaten fixed historically. So I'll do better with variable. Sure. But there's maybe, right? But there's risk level to that. And if interest rates do go up, which obviously we've seen that over the last year and a half, it's there's that level of risk.
Yeah,
for sure. And now maybe people's assets or rental properties that were cash flowing 2 years ago, if they were on variable, there's a good chance that they're no longer cash flowing. I mean, we've seen massive increases in mortgage payments, like, I don't know, $1,500, $2,000 a month.
Which is likely your cash flow.
Yeah.
That definitely makes things tough. Yeah. Actually, I wonder, because I know there's a lot of talk around interest rates, and this, like, this isn't like evidence-based or anything. This is all like hypothesis. But I wonder, because so many people thought that we sort of had our last rate increase, whenever not the most recent one in June, but the one before that. And they had said that they were going to hold things to see what happened. And then, inflation didn't go where they wanted it to. And now rates are on their way back up. And they're even saying, maybe 2 more increases this year. So I wonder if people thinking that was maybe it as far as increases go, and then likely things were going to go down if people hopped into something that was variable, hoping that they would see that decrease, when in reality we were actually now potentially seeing more increases. So anyways, just a thought.
We talked about it at the beginning of this, right? Interest rates could go up to like 18%. We've seen it in the past. Yeah. So I think really what it comes down to is debt can be extremely powerful. And for a real estate investor, that is really how a lot of people scale their real estate businesses, their real estate portfolios. People do use 100% leverage opportunities, and that can be incredible, right? You're not putting any of your money, any of your investors' money into that deal. Like, that can be an incredible opportunity, but you need to make sure that you have a good exit strategy from that, and then things are going to make sense. Maybe you're doing a big value add that is basically a guaranteed value add, or something like that, so that you're not at 100% leverage. Did you just use the word guaranteed?
Yeah. Like as guaranteed as you can be. Nothing can, I know nothing's ever guaranteed in the world of investing in real estate, but as guaranteed as it can be, that you know you're going to increase that value and it's not going to be leveraged to 100% for long. So use it as the tool it is. Understand it. Have a good relationship with debt. I
like that relationship.
Yeah, have a good understand it, have a good relationship, like do your research, have mentors that can teach you about debt and how to use debt, but also be careful with it because, you know, as great of a tool as it is, and as incredible as it can be to increase your portfolio quickly, it can also cause a lot of problems if you don't know how to use it properly. So yeah, learn about it, learn about debt. Don't let this be the only thing you learn about debt. Continue your education, and don't be afraid of it. Don't be afraid of debt, but you know, treat it appropriately. Treat it with respect.
Nice.
Yeah, that was welcome to my TED Talk.
Thank you for coming to my TED Talk. Love it.
Okay. Do you have anything else to add? I think that was.
No, I don't think so.
Okay.
I think we covered it.
We covered it.
I think we beat that one.
Okay, we beat debt. We're good. Okay.
Does anybody have a debt word counter going? How many times did we say it?
I hope not. Okay, so as always, I hope you enjoyed the power lunch. I hope you're enjoying this kind of off the cuff discussion that we're doing now, not as structured. If you have, as always, if you have any other topics that you think would be great to chat about, if there's something you want to learn about, if it's within our wheelhouse, we'll tackle it. Like Jeff said, we might even bring on some guests if it's not something that's necessarily in our wheelhouse. If you found this useful and you think others would, you know, feel free to share it. If someone missed it, it's going to be either on our Facebook, but it's also going to be on YouTube. So you can check it out there later.
Yep.
And we're going to be here consistently every week on Tuesdays, starting at 12:30 EST. I know there's people from not our time zone.
It might not be lunch for you guys, but
yeah, sorry.
You can watch it on YouTube at your lunchtime.
Yeah, there you go. Okay.
Yeah, drop a like, drop a follow.
If you have any other
subscribe.
questions, message us. We're happy to chat. All right.
Have a good
rest of your day.
Thanks, everyone.